Are you ready to talk about how to make a money pivot, how your credit, your taxes, your business strategy, and income all come into play? Well, on tonight's episode of Pivotal Change with me, your host, Ryan Conn, we're going to be talking about all of those items with Aldiva or Ali Rubalcava. She is an expert. She's also known as the FICO Diva, and she is the FICO Diva in many ways. She gives financial solutions through Aldiva's Financial Solutions, her actual company. She's a founder of Better Solutions Incorporated, which is a 501(c)(3), and you can follow her on multiple platforms. And we'll get more of that in just a minute. But if you don't know very much about this woman, you're going to definitely want to look her up because she has won substantial awards and she's going to be pouring out some serious advice and wisdom for you. So get your pen and paper ready to take some notes because you're going to need it. She is the Woman of the Year. She's been Business Woman of the Year, Woman of the Month through Power Magazine just in February. So you're going to want to pay attention to what she has to say. Allie, welcome to the show.
Thank you for having me.
Well, I can assure you the pleasure is mine, and probably more so the pleasure is going to be the audience's here in just a moment. What I like to do is I kind of like to warm people up with getting a little bit to know you a little bit, and then understand how and why your brain works the way it does. So, what I want to do is I want to talk about assumptions. When people maybe see you or even hear the word FICO Diva, what do they think of when they hear that, or what does that story turn into with the questions they ask you? Because I want to know the real story behind FICO Diva.
I started my business as recovery credit repair, and I was just focusing on credit repair and nothing more. And because my name's Aldiva and I deal with FICO scores, that's where FICO Diva came into play. And so when I was doing advertising with NBC and with other TV networks out there, they even told me, Allie, we couldn't have come up with a better name. You did a great job coming up with that. So that's how FICO Diva came about because I dealt with FICO scores and my name's Aldiva. So there you go.
It was a match made in heaven. It sounds like that's literally. I like that real story and about using your background to create your future. So let's talk about your background a little bit more. With fixing credit scores and now helping a lot of business owners change all kinds of things that we'll get into in just a moment. What's maybe a personal money lesson that you learned something possibly even the hard way that still guides you and how you teach others?
Yeah, so the biggest money lesson was I was a licensed female contractor in California for 15 years. And I, like many entrepreneurs out there, was focused on the gross income. I was not focused on the expenses. I was not focused on the net after the expenses. And so one of my big pivotal education tools that I teach everyone in is we don't live off of our gross, we live off of our net. So if you're not focusing on what your expenses are, where your money's going, how much came in versus how much needs to go out before you have what's actually left over, you're never going to overcome obstacles because you're always going to be robbing Peter to pay Paul.
I think robbing Peter to pay Paul is a cliche phrase that comes up in our line of business with helping other entrepreneurs and things a lot. And people are having to shift and move money everywhere, and they don't understand that big picture, that planning. People are not looking at their net profits, their EBITDA. They're not budgeting out these recurring expenses, and especially people like in construction. It may not be as bad in California, but construction in Kentucky is rather seasonal, right? And so they don't know how to ebb and flow with things like that. So that's a pretty good personal touch. And 15 years is that contractor position. I'm sure you're quite the minority of a female certified contractor like that, and so you probably had quite the view, quite the perspective to lend to your clients, which I like that. So
Yeah.
starting with that, was there any specific things that you learned that the world was teaching you about these risks and these margins and leadership over the finances for these people?
Honestly, I'm going to go back to 2008. Money was great. I was bringing in $5.5 million a year. And then the market crashed
Mm.
and everything took a dive. And I went from making 5.5 million down to 47,000. And then I was trying to dig myself out of the hole for 2 years. And I eventually had to file bankruptcy myself in 2010 because there was just no escaping that. It was so hard. Another thing I learned was, and a mistake that I made was getting those merchant cash advances, because they give you all this money, but then daily, as you're receiving the income, they're debiting 25% of your income to pay back that cash advance. So now you're down to 75% of your cash flow as opposed to 100% of your cash flow to go towards your debt. So you're just digging a bigger hole. And don't get me started on the interest rates. They're insane. So it's just things that a lot of people don't take into consideration, because I feel that a lot of our entrepreneurs are making moves based out of desperation, and they're not slowing down to evaluate what their business decisions are.
I like that. I've used, and you tell me if you think this might be an appropriate metaphor. I've used the analogy of the bigger your ship is going and the faster you're going. A lot of business owners are just driving that boat forward, right? And they're
Yes.
driving that boat forward. They're not looking back at the wake that they're causing.
Mhm.
And they're driving through their neighborhood, their little boat dock, and they're knocking all the boats out of the way. They're disrupting and everything's getting tossed and turned. So by the time they stop, there's this huge surge that hits them, and it all catches up to them and ultimately sinks their boat. Um, so I appreciate you pointing out some of those things and some of the dangers of that quick money, those cash advances, those merchant loans, and things like that. Uh, that can really damage that. So you obviously, having to declare bankruptcy, took a big hit to your credit score,
Oh
and
yeah.
there was probably a build back phase. So how long did it take you to build back a reputable score?
So that's the beautiful thing about bankruptcy, because some of you viewers out there watching, you might need to file bankruptcy. And if you do, I want you to know it's okay. And I say that because as soon as your bankruptcy is discharged, if you go chapter 7, not 13 or 11, because those are different. But if you go chapter 7, your bankruptcy gets discharged today. You can get a secured credit card tomorrow. You can rebuild your credit in the next 45 days. And creditors love you after bankruptcy, because you can't file bankruptcy again for 8 years. So now they're protected from you.
Right.
And if your goal is to buy a home, 2 years after your bankruptcy discharge date, you can actually close on a home. So if bankruptcy is in your future, don't be afraid. It's okay. You're not the only one out there that's going through it. Just know that there's peace at the end of the chaos.
Yeah, I think that's great advice. I think people genuinely need to hear a lot more that whatever situation you're in, you're not going at it alone. And so
Mhm.
whether that's the highs or the lows, you can find people on both ends of the spectrum that can help you work through those. So let's talk about one of the highs real quick. Back in 2006, Businesswoman of the Year. It's a pretty big deal.
Mhm.
What did that season cost you behind the scenes, in order to earn and work towards that title? And then what did it unlock for you next?
So, what was happening behind the scenes was I was one of the few female licensed contractors in California. I had 100 men working for me. My payroll was through the roof. I had high workman's comp, not because we had any accidents, but because of our classification code at the time. So there was a lot of expenses that were rolling out, your general liability insurance, your bonds, your contractor's license, like all these things that you have to maintain. And again, focusing on the gross and not preparing for what was to come, because we kept seeing, all of these negative amortization loans that were happening. So I'm going to tell you about my case, because I was a victim of it. I shouldn't say victim because I bought into it, but I also had fault in it. But I was a victim of it. And what I mean was I bought, and what I'm going to tell you guys are crazy numbers, but they're factual. I bought a $700,000 home, and my mortgage payment was $1,300 a month. That's less than the interest on the home. Okay, that's why they were negative amortization loans. They were going backwards. So as I'm paying my $1,300 a month, there was more interest accumulating on the back. So then 3 years later, when the loan amortized, my $1,300 a month became $6,000 a month. I had to do a short sale on my home, sold my $700,000 home for only $350. to someone else. And now that home is worth over $1.5 million.
Wow. Wow.
So, yeah.
That's very tough. So last question, we got maybe 30 or so seconds before break, but when did you realize that your lane wasn't just building businesses, it was building financial confidence from all of these lessons and life experience?
Honestly, it was the more I speak to people, the more I hear their stories, I look beyond their situation. I tend to listen to them with a different ear, and I tend to pick up on their habits as they're describing things to me that make sense to me, that help me explain things to them to where it makes sense. And that's what opened up my doors to all this education that I do now.
I like that. And I'm going to describe it for movie lovers out there. It's like when Neo can first see the Matrix for the first time and he can see all the numbers running. You're looking at the person or the business and you're seeing the numbers, the habits, the situations behind the scenes. And I think that's really important. So we're going to stick a pin in the conversation right here in just a moment. We're going to return and get a little more tactical, a little bit more specific about credits and taxes and funding and stuff like that. So everybody sit tight. We'll be with Allie here in just a moment after this break. Welcome back to Pivotal Change, and thank you for sticking with us through that commercial break. The real cool part about this show and this network is that you can find us anywhere, anytime, because we are streaming and live on demand. You can go to the Now Media TV website. You can find Pivotal Change, this show, your favorite, and many other of your favorite shows as well, and they're all in English and Spanish. So just work through the menu, pick whatever you want, and the nice part is it's iOS, it's on Roku, you can find us on YouTube, pretty much everywhere, and you can download the podcast version at nowmedia.tv. So catch it on the go, even if you can't watch, you can still listen to your favorite shows. So we're going to roll back into this conversation with Ali Rubalcava, and she is the FICO Diva, and she has some incredible financial advice. She's just telling us her background, her story of even having to claim bankruptcy herself and building out of that and giving us some anti-fear tips into doing that. So we're going to jump down on the weeds a little bit more, give them maybe a little bit more tactical. And so I'm sure you hear this a lot, but somebody that you're working with or potentially working with comes up and says, yeah, but my credit is bad. What are the first, maybe let's say, two things that you look at to tell whether somebody is like a quick fix or they're going to be more of a deeper build?
So number one is, are you maxed out on your credit cards? Because a lot of times you have no collections, no charge-offs, and your scores are low. That is a clear indicator that you are overspending on your credit cards. What does that mean? That means if you're spending more than 30% of your credit limit, you yourselves are dropping your scores 80 to 120 points. So I want you guys to think of a credit card, anything that's revolving, which means I could spend it, I could pay it, I could spend it, I could pay it. That's why it's revolving debt, right? So I want you guys to think of when you were a kid and you played on a teeter-totter. So when you have zero balances and zero debt, you're level. There's nothing to push you up or down. But the minute your debt starts going up on those cards, your scores start going down. The minute your debt starts going down, your scores start going up. So when you think of debt down, scores up, debt up, scores down, that makes sense. The second thing is charge-offs now, and collections. Depending on the state that you're in, we have a thing that's called statute of limitations. So for example, California, Texas, Nevada, they only have 4 years to collect on a debt. Arizona, Washington, Oregon, they have 6 years. Tennessee and Wyoming, y'all have 10 years. So it's really important to understand how long debt's legally collectible in your state, and it's from the date of last payment, not from the date you went into collections.
That's very good information to know. And, so a quick little thing. Some people are in the service industries and they say, hey, I'm going to engage in a project for you. And it might be a 2-week project, 2-month or 2-year project. And they don't invoice to the very end of that project. Somebody stiffs them on the bill. How does that work in a situation where people are trying to chase down work they've been doing for the last year or two?
So that's where it's important to have what's the word I was looking for? I just lost my train of thought. When you bill in advance, not in advance, but why can't I think of the word? I'm having a brain cramp.
You do the project completion and you bill after the project, the results are all done.
No, but you can also do the billing where as you complete certain steps.
Oh yeah, phased out building like construction phase, things like that. Yep.
Exactly. So it's important to do that. And also be clear on your contracts, because one thing I'm going to tell all of you right now is, what are we doing nowadays? We are getting a DocuSign. And what are you guys doing on your DocuSign? You're going, oh, I got the contract. Deep, 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 signed, approved. And how many of you are downloading that DocuSign? And how many of you are reviewing it? And how many of you are reading the fine print? Very few. Because you guys are taking what the other company's saying at their word. But what's on paper is what matters, not someone's word. So it's really important to always download those DocuSigns, read, highlight, question whatever you're not sure about. Yes, it's time consuming, but chasing money is even more time consuming. Okay. And in that way, you don't sign something and get into a contract that you're not aware of. Some government contracts, they take 90 to 180 days to pay. Okay, are you able to front the money on the labor, front the money on the material, front the money for anything for 90 to 180 days? Only you can answer that if you're watching.
Great advice. So it's the power of your contract, and that written word is going to supersede any verbal agreement, any, what promises that were made, unless you can, I guess, record or put down on paper those promises. So great answers. I like that a lot. So going with people that are having these credit issues, and I know we got on tangent there a little bit. What's the difference between like credit repair and just having a credit strategy? And why does the distinction change really everything?
Yeah, so credit repair is when you actually have negative items on your credit report that are not factual and that are inaccurate, and that we can actually go after and remove from your credit report. Now, anything that's factual and accurate is very hard to go after because you actually did it. So what I mean by that is, I'm going to pick on late payments. Everyone's always worried about, can I get these late payments removed? Okay. If you were physically late in February of 26, but they reported you physically late March of 26, but March you have proof that you made the payment on time, that's an inaccurate error that can be resolved. But if you were physically late in February and they reported you physically late in February, that's always harder to resolve because you actually were late. So you need to keep that in mind, because I know a lot of credit repair companies out there will say deletions in 90 days guaranteed. First of all, it's illegal to promise or guarantee anything in credit repair. You need to know that. Second of all, there are some strategies out there that are not lawfully done. You need to be aware of that too. And third of all, you need to know that not everything can be fixed. Yes, a lot of things can be fixed, a lot of things can be corrected, but not everything can be fixed all the time. So if it ever sounds too good to be true, keep your spidey senses up, because more than likely that's what's happening.
I like that a lot. And I really appreciate you making an emphasis on the promises and guarantees. There's very few, if any, promises and guarantees in life other than like, hey, we're all going to die one day, right? And so that's really important. So if somebody's making the promises, the guarantees that we can remove this, we can reduce that, you're probably looking at maybe some scammers. And like you said, your spidey sense should be something that you rely on, and at least do further research, get some testimonials and referrals and things like that. And again, nowadays with the internet and AI, you can probably get some pretty credible research pretty quick about how that stuff works. So thank you for explaining that. So tell us a little bit about DSCR and how you've broken that down and how that works with real estate credit, because you've talked about that on your show.
Mhm.
So tell us about that. And like, what's the number one way that people maybe misunderstand stuff revolving around leverage and they end up somehow trapped?
I love DSCR loans. So in order for you to get a DSCR loan, there's two ways. One, you either have to have a corporation or an LLC, or two, you can be an individual to qualify for a DSCR loan, but you have to own your main property. So keep that in mind. What I love about DSCR loans, especially if you have an LLC or a corporation, is that you have to put down 20%. You have to put down your closing costs. And as long as your mortgage is 1% less than the rent in the area that you're buying, you qualify to buy that property. Now, a lot of lenders do not report, and I'm saying a lot because some do, but a lot of lenders do not report that debt on your personal credit report. It's only reported under the LLC's name and the EIN number. So then whenever you go to buy property for yourself, it frees up your DTI because that loan isn't reporting on your personal credit report. Like I said, sometimes some lenders do report a DSCR loan on your personal credit, and as long as you have proof it's a rental, that can reduce your DTI, your debt to income ratio. But
Like,
I love the product. I think it's awesome.
good. So people need to investigate that. And if they need some advice, they probably need to tap you on the shoulder for that.
Yeah, I'm
So
not a lender, just so you know, I do not do lending, but I do have a lot of lender partners that work in multiple states.
I love that. See, that's for me part of I like being the person that like, well, I know the person, I know the guy, I know the gal. Let me
Mhm.
hook you up. And brokering, that's another thing I do. I broker a lot of stuff for people that, but that's not what we're talking about. So let's go back to the small business owners because that kind of seems to be a niche. What's maybe like a funding move that you see a lot of them jump into? It's a good move. Maybe they're chasing it too early, or it's confusing. Like, hey, all my friends are doing it, but it might not be right for them. What should they build first so that lenders are going to actually take them seriously?
So number one, there are some nonprofits out there that work with startup businesses, and they do give you startup loans, but you do have to have a business plan in place. Okay, they want to see what's your projected income, what are your projected expenses, what's your projected growth, in order for them to buy into your dream. But there are funding sources out there for startups. The majority of them want to see that you have at least 2 years in. And so what I see a lot of mistakes that people do when they form their corporations or their LLCs is they stay stagnant for 2 years to let that 2 years grow, as opposed to get yourself a secured credit card under your EIN number and start building your business credit to make you more credible for when your 2 year mark gets there.
I like that. I like that. So here in just a moment, we're going to come back from another break. But first, tell us how to get a hold of you. If we're liking what we're hearing, how do people find you?
Yeah, so obviously our website is FICODiva.com. You can call us at 559-372-2823. Text us 559-744-4011. You can follow me on Instagram, on TikTok, on Facebook under FICO Diva. I'm also on Snapchat, WhatsApp, you name it, I'm there. So yeah, just look for us, follow us, call us, and let's start talking.
We definitely are able to find you, and you'll be able to find us here in just a moment after this break. Congratulations, you've made it past the halfway point of pivotal change, but we're really just getting the fun started here. We were starting to get into some of the nitty gritty, some of the real tactical strategies and advice that you can take home with you. So keep that pen and paper ready. We've had all kinds of discussions about credit repair and credit strategy and getting into what types of loans might be available, types of timelines it is to be able to get into some funding options for your business to help you grow. But we're going to kind of get in some of the no fluff area as well too. So Allie, let's talk about maybe some no fluff credit rules. What are maybe three habits that could build credit quietly over 6 to 12 months and three habits that sabotage every person trying to get that high score?
So the first three habits are using more than 30% of your credit limit. Getting a lot of, I'm going to pick on these buy here, pay here now companies that give you 6 months, same as cash. And the reason why I'm picking on them is because they give you these little micro loans, 6 months, zero interest. You make your payments on time, you pay them off, and then what happens? It closes the account and it dings you 50 points. So I've seen people with like 30 of these little pivotal 6 months, same as cash accounts on their credit report. I really wish that these accounts would convert into revolving as opposed to being installment debts, because then it would help the consumer more. But every time that you open one of these accounts up, you make your 6 months on time, you're perfect, you're never late, your scores are going up, you pay it off, it dings you 50 points. So that one drives me insane. And what's the third one? The third one is not checking your credit. A lot of people think that credit, well, the one that's online that starts with a CK is is a good source, and it is. Except you need, and then you're like, well, I review my Experian on Experian.com. Okay, so you've got this online resource that's based on a Vantage 3.0 score. You've got Experian.com that's based on a FICO 8 algorithm. So you're reviewing two different algorithms and you're not understanding why your scores are so different. And that's the main resource. That's the main reason, is that you're looking at things from different platforms. And then you're looking at your credit scores on your credit card apps. Those are all based on FICO 8 because that's the algorithm that credit cards use in order to approve you or deny you for a loan. Now, when it comes to mistakes that I see a lot of people do is people want to carry zero balances on their credit card, which is great. However, whenever you keep a zero balance, your credit's reporting like it's asleep. Even though you used it and you paid it off, it still on paper looks like it's asleep. So what I tell people is allow a $5 or $10 balance to report. Yes, you're going to pay interest on that. I don't want to hear it, but it's going to wake up your credit because now there's going to be a little balance reporting and it's going to shoot up your algorithm higher. So, and those of you who don't believe me, try it. Let me know how it works out.
Well, I'll be a testament for that. I got some really good advice from when I was in college, and I opened up the Discovery had a student loan credit or student credit card. It was a $500 max limit. And so my rules were this is for gas only. So I only use gas. And again, this is back a couple of years ago when gas was cheaper. And so I would run up 50, 75, 100 bucks a month and I would pay off 90% of it every month, right? And so if I had 100 bucks, I'd pay 80 to $90 a month, carry $10 over. I didn't know what I was doing. I was basically just throwing the money I had at it. Um, and a couple of months I paid it off and tried to carry very little forward. I was very disciplined. This is for gas only, right? And I got out of college with a bunch of student loan debt, and my credit score was like in the 690s as a college student and then only grew from there when I finally got a real job, real career. So that is something that can build credit fast. And that's what I do with a lot of my pre-entrepreneurs, like a lot of the young people that I coach into getting ready for business. And so that piece of advice is a little gold nugget that she just gave you folks. I hope you write that down and start doing that today. That's a big one. All
Yeah.
right. So people get some credit surprises. Uh, they don't know how to follow your no fluff advice, but now they wrote down the 3 and 3. So now they get around to, okay, I'm running my business. Hey, my gross numbers are looking good. You told me to watch out for my net numbers. I'm getting my credit under control and I'm not paying a whole bunch of interest. My score is going up, but all of a sudden, boom, tax season hits and they get this big tax season surprise. And small business owners run into this all the time. So what do they need to start doing to track monthly and quarterly to be able to be prepared to handle taxes?
Books, 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 books. And I mean it all the time. Do your online QuickBooks. I love QuickBooks Online. It's one of my favorites. If you prefer Excel, if you prefer other software, it's whatever you're most comfortable with. But books, books, books. Okay. And what I mean by books is you don't just go in and put in your transactions.
Right.
You actually have to go in and you have to do a bank reconciliation every month. So what does that mean? That means that my bank statement shows this, my QuickBooks show this, and at the end of the month, I'm zero, which means that I'm balanced. So that means that my bank statement and my QuickBooks all balance. One thing I'm going to warn you guys about QuickBooks, especially when you have the auto dumping feature. I cannot stand QuickBooks auto dumping feature. I'm going to tell you why. Okay. Yes, it's convenient because it's linked to your bank account and it's automatically putting things in for you. But it's misallocating funds, it's duplicating transactions, and if you're not on top of it, it could actually cause you to owe more money in taxes. Okay, so it's really important to review your books. Make sure that you're doing your monthly bank reconciliations. Make sure that if there is a duplicate transaction, that you're voiding it. Never delete, because if you ever get audited from IRS, they want to see voids, not deletes, because that's a proof of something. Okay, so it's really important that you track these things and that you see where you stand, because a lot of mistakes that business owners make is they're like, oh, I spent all this money here and I forgot. If it was used with a business bank account or a business credit card, and you had everything allocated, it would be in your expenses. It would be in your profit and loss. Okay. Another thing too is interest on credit cards. That's a write-off. Interest on your corporate vehicle. That's a write-off. Miles. Many of you drive forever and you're not tracking your miles. Now, commuting miles do not count, but going from your office to a job site and back, those count. If you're an investor and you're out there reviewing properties, all those miles count, and you're not logging them. Why? You need to log these things.
I love what you're saying here because, when in the accounting firm, the number one problem is dirty books. We have to clean up the books. And of course, that's a headache. And the human memory only serves you so much. It's Mark Twain that said a short pencil is better than a long memory, which means write it down back then. Well, now we have computers. Get an accounting software, get your bank balances in order, get everything lined up, because we see business owners running literally multi-million dollar businesses out of the cash register. Like, well, they look at their bank account. Do I got enough money to make this purchase? Or shoot, my bank account's a little low, so I better drive up some sales, instead of having a true financial position and picture, because they understand and have clean financial statements.
Yep.
And then you'd mentioned write-off and deduction. So that's common language for us, but break us down a little bit about write-offs. They're not just free money, right? So what's the difference between being smart with your deduction strategy and maybe deductions or write-offs that ultimately create a long-term mess?
So honestly, what I've been finding, and correct me if you've been seeing other things, is that people go in to do their taxes and they go, here's my income, here's everything that I spent my money on, here you go. And the tax person goes, okay, you now owe this much money. There's no questions. There's no, based on your type of business, typically you have this kind of expense or write-off, do you? There's none of that. You're in and out, and like Taco Bell, like in and out in 2 seconds or less, and that's not the proper way for a business to be doing their taxes. And then also, if you as business owners are always writing everything off, and then you decide you want to buy a home, that can prevent you from buying a home. So then you need to know that you need to report X amount of income and have your adjusted gross income show a certain dollar amount so that you can qualify to buy that home that you want to buy for your family, and for 2 years, not one. And yes, you're probably going to have to pay taxes on that income that you're reporting, but that's okay, because you're going to get the ultimate goal of owning your own home. So there's a lot of things that strategically you have to consider when you're doing your books and when you're doing your taxes, because sometimes not all write-offs are good write-offs, especially when you have a goal of buying a home.
I love that. Yeah.
And also, if you're always reporting a loss, the IRS is going to be like, this is more of a hobby. Why are you even in business? So
That hobby word is a huge buzzword in the compliance and attestation and auditing world. So that's a good point made. So we got about just like 20 seconds before we cut to a commercial break. So just maybe pull out one habit that you see entrepreneurs do that is a magnet for stress every spring during tax season.
Um, I'm gonna pick on the tap and go. This thing is not your friend. The convenience of tap and pay is not saying, I have $1,000 in the account. I just tapped 300 bucks. I have $700. You
Yeah.
guys are too focused on what's in the bank account and not focused on the expenses. So stop
That
it.
beautiful statement. You're too focused on the actual bank account and not on the expenses or the projections. So that's a great place to pause. We'll be back for our final push of the night here in just a moment with more Pivotal Change. Did you know Pivotal Change could be found anytime, anywhere that you have data or wireless connection? Because it is on demand. You can get it on the Now Media TV website. Here's an example of Pivotal Change. You drop down, you pick from any menu of whatever you want in English or in Spanish, the multilingual network for everything from culture to arts to news to media to leadership and business. And you can find it all in a podcast version as well. You can listen on the go, find it on Roku, iOS, YouTube, and the nowmedia.tv website. So we're going to get back to this episode here, and we're going to get through the big push because Allie, the FICO Diva, has been leading us to something. We're talking about fixing your credit, all of these hazards and things to watch out for. Not all write-offs are good, and how to plan for your future, but not just your immediate future of maybe getting out of debt and raising your technical credit score, but building generational wealth. So if I said to you, I want to build generational wealth, what's the first boring financial thing you would tell me to start looking at or doing?
I would start looking into IULs and I would start looking into life insurance, especially if you have kids. Um, do you know that you can actually get a policy for your baby at maybe 30 bucks a month and it'll stay that at that rate till they're 99 years old, and by the time they're 18 they can actually buy a home cash because of that life insurance policy. And a lot of people don't look into that. We'll spend $30 or more on our nails, but we won't spend it on something that's actually going to build that generational wealth. So I think
Yeah.
it's really important to consider that. We do so much mindless spending on things that don't matter, as opposed to actually getting something that does matter and helps us with our future and helps our children grow as well.
I think you just said something really important. Is that one, there's areas that's an investment ultimately, the areas to invest in, to look at, and to capture future resources based just on looking around and asking a few of the right people. And another thing too, your mind shift there was, hey, this is the cost of my nails getting done, right? And I started to think about that a long time ago. So a long time ago, I was trading time for money. I worked at an hourly rate, and now I work on a value-based type of proposition. But in both scenarios, let's say I wanted to say, hey, let's take my family out to a nice celebratory big meal. One of these big meals for a family at a really nice restaurant could be 300-400 bucks these days, especially if you let your kids order steak because you're celebrating something, right? And so you get a $400 meal. And in my head, I was like, man, I got to work 3-4 hours in order to pay for this meal. And then now, if I want to take my family on a vacation, I say, I want to upgrade our vacation. Let's go someplace really nice. I have to do so many advisory packages or so many value-based profit. I need 3 new clients to pay for this vacation. When you start thinking about it in that trade-off, I think you can start building generational wealth. I can either buy this cup of coffee for $5 a day for the rest of the week, and I'm working, let's say I do that 6 times a week, that's 30 bucks. Or I can make coffee at home and pay for a life insurance policy that's guaranteed to make my child a millionaire, right?
Yep.
So I really, really like that you pointed that out. So let's shift to your not-for-profit lane. Instead of keeping everything inside your for-profit work, what gap are you seeing in communities that are making you push into this area?
So what I feel is there's a lot of financial literacy need out there, especially when I was in high school, we used to learn how to use a check register, how to write a check, how to balance a checkbook. What does that look like nowadays? And you know how many adults I speak to that have never written a check in their lives, have never seen a check register in their lives, and they're just so focused on my app says I have this much money, so I could spend this much money. And they're not focused on the reality of I just made $1,000. My rent is 800. I only have $200 to put gas, put food on the table, and last until my next paycheck. So what does that look like? Or do I get $1,000 a week and my rent is $800? So do I put $150 a week in savings, even in a money market savings account that's earning you 3.75% interest as opposed to that lovely one miserable penny a month that we get. And that way your money is growing with a little bit of interest, with a little bit of money that you have in there. And then when it's time to pay your rent, you've already put that money aside. I feel like everyone's focused on this is what I have in my checking account, and no one's transferring into a savings account that can grow a little bit. So then when it's time to pay the bills, then they just transfer it into the checking and pay it. So it's a mindset change that I'm trying to create out there so that people can start being more financially savvy. I can't stand when people say, they don't teach us in school anymore. They really got to teach us. Yes, they don't teach us that in school anymore. And I'm going to tell you this. Now a lot of schools are trying to get into financial literacy. How many of those educators, and I say this from personal experience, from people I personally talked to, I'm not saying that everyone is in this category, but it does exist. How many of the educators out there are living paycheck to paycheck? They're not balancing their books, but yet they're the ones teaching us about financial literacy, and they're teaching our youth. So it's things to consider. And I feel like that there's a big gap and there's a huge opportunity out there that needs to be fixed.
I think you tiptoed to the next question I want to answer you, so I'm going to tweak it just a little bit. But what you're saying is so important: is who are you actually listening to give you your financial advice? Most of what they teach you in school is how to get a good grade on a test, so that both you and the school get funding and a college application approved, right? And so you have to teach this mindset shift. And so I'm in my 5 M's program. Mindset is the number one. It's the first M. So are you teaching these youth, these future entrepreneurs, you teach them more about budgeting? Are you going credit scores? What are you doing first before anything else with that mindset change?
So what I'm doing is I'm making them. So I actually am the financial literacy coach for a nonprofit, for another nonprofit. And so with their students, when they come into my class, I don't tell them what I'm doing, but I make them open up their bank apps and I make them download their last monthly statement. And I make them write down, this is how much income came in. This is how much I spent on food. This is how much I spent on coffee. This is how much I spent here, how much I spent there. And the aha moment at the end is crazy. Like some of them are like, how did I have all this money left over? Where did it go? Or some of
Yes.
them are like, I didn't even realize I spent that much money here. So by me inadvertently making them do the work, it's opening up their eyes.
I like that. So you're putting it instead of that transactional mindset and that transactional life, you're saying, I'm going to at least put 1 month fully in front of your face, make you write it down and highlight, underline, and add up certain categories. Like, again, how much did I spend on coffee this month? And people get shocked because you put it all right in front of their face.
Yep.
That's really good. So there's a form of leadership in doing that. So speaking of leadership, you have something that it's called high standards with a high heart, right? And so what does that look like when you're serving people who might even feel ashamed about their money or money situation?
So that's one thing with me is that I don't care where you came from. I don't care what happened in your life. I don't care um, about your past. because your past is behind you. I care about where you are right now. And my biggest goal is if you come into my office or I meet with you and you walk in with your head down, I'm going to make sure you walk out with your head high, because there's always a goal to be achieved, and never be ashamed because life happened, because life happens to everybody out there. And you're not above or below anyone else. You're special, you're unique, and you're deserving.
Love it. So what's the most powerful before and after transformation that you've witnessed?
Ooh, there's been so many. One of them was a person who came in, and so they owed over $260,000 to the IRS, and they were terrified. And we didn't offer and compromise, and IRS settled for 21,000. And now they're just so proud because they were able to save all that money, and make a change in their lives. And they feel like that monkey is now gone, like that weight is gone, and they feel free.
The amount of stress that must have been off of their shoulders and the ability to get stable again. That's an incredible story. So let's give us the last thing of the night. You got to leave us with the three moves that you want them to take in the next 7 days. Go.
Number one, download a bank statement. I really want you guys to do this. Download a bank statement. Look at your income, look at all of your expenses, see where your money's going. You're going to be amazed at where there's so many money saving opportunities that you're just not taking advantage of. Number two, check your credit. And it's okay if the numbers are low. It's okay if the numbers are high, but see where you stand. Okay. You need to get a grip on that. A lot of you do not. A lot of you do, but a lot of you don't, right? And then third, ask questions, reach out. Whenever someone tells you the word no, I never want you guys to take it as a negative, because to me, those two initials NO stand for new opportunity. So when someone says no, be like water, pivot, and now you have a new opportunity that's going to open up doors for you because this one said no.
Allie, where do we find you if we want you to be that person we ask for help?
Yeah, so reach out to us via online at FICODiva.com. You can reach out to us on Facebook, TikTok, Instagram, WhatsApp, Snapchat. It's all under FICO Diva. And of course, give us a call, 559-372-2823. Give us a text, 559-744-4011, and we're here to help.
Allie, thank you for coming on the show with all of your wisdom.
Thank you for having me.
To everyone else out there, I want you to go into the world and I want you to see the change and be the change. And we'll see you next time on Pivotal Change.